Benjamin Franklin said, "In this world, nothing can be said to be certain except death and taxes." At least with taxes, they keep changing. That's one of the things that makes practicing tax so interesting. One of the consequences of the U.S. Supreme Court's recent upholding of the Patient Protection and Affordable Care Act is that a new 3.8% Medicare investment income tax, let's call it the mid-tax, is scheduled to go into effect on January 1, 2013. I want to discuss how the rules work and some tax planning issues the new tax raises. First of all, most taxpayers will never have to pay the tax. It applies to joint filers with an adjusted gross income of more than $250,000 or single filers with adjusted gross income of $200,000. That represents only the top 2% of U.S. taxpayers. Unfortunately, these thresholds are not indexed for inflation, so over time, more and more taxpayers will become subject to the tax. Adjusted gross income is the number at the bottom of the front page of the Form 1040. It includes interest, dividends, capital gains, wages and retirement income, plus results from limited liability companies, partnerships, and sole proprietorships, but it doesn't include subtractions for itemized deductions, such as mortgage interest and charitable gifts, or personal exemptions. Currently, the Medicare tax only applies to wages and self-employment income. Starting next year, it will apply to most but not all income from interest, dividends, net income from rentals, and net capital gains. The new tax applies to the lesser of the investment income amount or the taxpayer's adjusted gross income in excess of the threshold. For example, Jane's a single taxpayer, has $140,000 of wages and $50,000 of investment income. She would not be subject to the tax, since her total income is under the threshold. Similarly, if she had $160,000 of wages and investment income of $50,000, only $10,000 of the investment income would be subject to the tax. Although she has $50,000 of investment income, her total income is only $10,000 above the threshold. So what kind of income is investment income? Unfortunately, we're still waiting for guidance from the Internal Revenue Service. However, it appears that the tax applies to dividends, rent, royalties, interest, except for municipal bond interest, short and long-term capital gains, the taxable portion of annuity payments, income from the sale of a principal home above the $250,000 or $500,000 exclusion, net gain from the sale of a second home, and passive income from real estate and investments in which the taxpayer does not materially participate, such as a limited partnership. The tax does not include payouts from regular or Roth IRAs, 401k plans or pensions, Social Security income, life insurance proceeds, municipal bond interest, veterans benefits, or any business income from a sole proprietorship, LLC, partnership, or S corporation, which are already subject to Medicare tax. Tax planning. One obvious plan to be considered is accelerating income subject to the tax into 2012. For example, a taxpayer holding on to stock with capital gains could sell them in 2012 rather than waiting until 2013 or later. There's another reason why this plan might be advantageous. Currently, long-term capital gains and most dividends are taxed at a maximum rate of 15%. The new Medicare tax would increase the maximum rate to 18.8%. However, the favorable tax rate on dividends and long-term capital gains expires on December 31st, 2012, unless Congress takes action to extend the rate reduction. If Congress allows the tax rate set in 2001 and 2003 to expire on December 31, 2012, the top rate on capital gains will rise to 23.8%, and the top rate on dividends will nearly triple to 43.4%. A lot will turn on the outcome of the upcoming national elections for President, Senate, and the House of Representatives. Uncertainty about the 2013 tax rate is another reason for considering selling appreciated assets in 2012. On a longer-term basis, taxpayers subject to the tax must seek to manage both their adjusted gross income and their investment income in order to minimize this tax. One possibility is investing in municipal bonds, which do not increase adjusted gross income and are not subject to the Medicare investment tax. Another alternative is investing in a Roth individual retirement account. Withdrawals from a Roth IRA, as opposed to a regular IRA, are tax-free. Similarly, investing in traditional defined benefit plans can have benefits. The payments to the plan reduce business income and therefore reduce adjusted gross income, making it less likely to be subject to the tax in the short run. And in the future, when the benefits from the plan are paid, the payouts aren't subject to the 3.8% tax, although they will increase adjusted gross income. Sale of a principal residence. When you sell your home at a gain, you might be subject to capital gains tax on the profits. However, assuming you meet certain requirements, it's possible to exclude the first $500,000 of gain for joint filers or $250,000 of gain for single filers from any tax. Any gain from the sale of your home, however, which is not eligible for the exclusion or which exceeds the maximum exclusion, is subject to the new Medicare tax. Let's talk about choice of entity. One important aspect of the Medicare tax on choice of entity is whether to do business as an S corporation or a limited liability company. There's been a huge growth in businesses conducted as LLCs. That may change soon due to how the mid-tax applies to these two entities. For example, assume that business A is wholly owned by A and operates as a subchapter S corporation. Business A earns $500,000 and pays A a salary of $200,000. A will report all $500,000 as income on her tax return, but only the $200,000 salary is subject to Medicare tax. The remaining $300,000 is not self-employment income, nor is it investment income subject to the mid-tax. Compare that with business B, which is wholly owned by B, but operates as a limited liability company. Business B earns $500,000. B will report all $500,000 of income on her tax return, but the entire $500,000 is subject to Medicare tax, regardless of the amount of salary she has paid. As you can see, taxes always change. Tax changes lead to changes in planning. Planning leads to changes in structuring, all of which leads to a really exciting and varied tax career.